Okay. So yeah. All right. So who just started? All right. You're lucky that I didn't saw you, but next time, you're out, my friend. Okay. All right. So I want to welcome everyone into this first course. It's gonna be really interesting. Um, so this Wiseguy Education University is brought to you by 428, the CEO, Vibe, Fong, me, and Dr. Ninja will be your three educators, and EDC will be the admin of this program. Okay. All right. So let's jump right into this. Okay, so today it's going to be an introduction to the stock market, pretty much. We're going to talk about everything that is like just an intro. So we will be like just planning through these slides, through this slide. Um, this is just before starting. This is going to be, of course, very basics. Okay, like very basic stuff for anyone. So if you don't feel the need to be here, don't force yourself. This is just like choose the topic that interested you, and yeah, so make this like useful for yourself. Okay, I have two questions. It's gonna be the last two questions before I start. All right, Kimberly, go ahead.
A lot of people in the chat are saying that you're not recording. Sorry.
I'm recording right now with OBS.
Oh, okay. Sorry. Never mind. Bye.
Okay, see you. Oops. Okay. All right. Is everything okay? All right. Okay, guys. Introduction to the stock market. We are getting in. Okay. So hi everyone. My name is Fong. I'm one of the three educators that will give you the university content for Wiseguy. Okay. I'm very glad to meet all of you. And let's start this presentation by one quote that myself I like to say. So trading is a game that we are our own opponent, right? Um, so I'm just gonna let you guys with that quote. Okay. Disclaimer: we are not a financial advisor. So this is for educational purposes only. So yeah. All right, guys. So before starting, I love to use pictograms in my slide for you guys to kind of get the quick idea of what to do when I enter a new slide. Okay, so the book will be for Wiseguy resources that we have in the community. Um, the pen will be for. I highly suggest you guys to take note when I'm pulling up the slide. The gear will be a situational problem that I will expose you guys to. The pen will be important ideas that you guys need to understand or to remember. Okay. And the lamp or bulb will be like a quote that myself or somebody said that I think it's important. Okay. All right. So here's the table. Okay. Um. So here's the table of content. Okay. Today we're gonna be talking about what is a stock. I'm gonna start by that, and then we are going through some brokerages. Next will be cash account versus margin account, like to really understand the differences. We will be presenting some indexes, and the last part, which will be the fun one. Okay. What kind of trader are you? And I will have a special assignment for you guys for this part. Okay. So first, what is a stock? Like, you guys are in Wiseguy, right? And we talk about stocks a lot. We talk about options. We talk about everything. But sometimes just returning to the basic, just understanding what is a stock, why does company um like created that kind of system? Okay, that could be interesting. All right, fun fact. Fun fact, guys. The first company to issue bonds and shares to the general public was the Dutch East India Company in the early 1600s. Okay, so the concept of stock and trading has been like pretty much been they existed since a very long time, and I can't precisely remember, but options actually existed before stock. Okay, we saw some options like trace in the middle age, I think, that people are like betting on their crops and on and all. So if you guys want to know more about this, you guys can search for the history of options. It's very interesting. Okay, and another fun fact, the Amsterdam Stock Exchange was the first official stock exchange when it began trading the VOC bonds and shares in 1612. So here's two picture of the Amsterdam Stock Exchange, and this is dating from like the 1600s, guys. Like this was a long time ago, right? So we can see the the building here. It looks a lot like the New York Stock Exchange, like the kind of agora that we have in the middle. And people here are talking. It looks like they're trading maybe the VOC stock. We kind of see multi-class people. Okay, um, like some rich dude, some poor dude, maybe some. All right, so it looks a lot like the actual stock exchange. So I found that very interesting. All right, what is a stock? Right, what is a stock really? A stock is a security that represents the ownership of a corporation. Okay, it's basically the corporation that you divide in a million or billions of small part, of small like individuals shares that you can buy and sell. Stocks are bought and sold predominantly on stocks exchange, like the New York Stock Exchange, the Nasdaq, the Toronto Stock Exchange, or the London Stock Exchange. But you guys need to know that there's a lot of transaction that goes behind those public stock exchange. Okay, like when institution makes like um, buy or sell a stock, they kind of have their own exchange for them to be ordered to do that. But for the general public, these transactions have to conform to government regulation, which are meant to protect investors from fraudulent practice. Okay, and this is regulated by the SEC. You guys may hear that a lot. Security and Exchange Commission. This is on the U.S. Okay, this is for protecting the U.S. investor or the general U.S. stock market exchange. Understanding stocks. What is the purpose of a stock, right? So corporations sell stocks to raise fund to operate their business. So you can kind of see this as a trade where companies or corporation wants to raise fund, okay, for their next project, for the research and development, for everything, and they will sell to the public stocks that we as retail trader will buy them, and by doing that you are literally giving money to the company, right? You are exchanging your cash in exchange for stocks or share. Okay. Um, when you're a shareholder, you basically have three rights. Okay. So you have the right to vote during a meeting, a company's meeting. So for example, if I own a Neo stock, I can be assisting on the Neo financial quarterly result, and I can attend to their meetings. Um, Stockholder can also receive a dividend if the company does offer a dividend. Okay, and it gives you the right to sell your shares. So it's not a lot of right, but I guess just owning a position is sufficient itself. Some distinction, right? Shareholders do not own corporation; they own shares issued by corporation. So there's a big distinction to understand here. Okay, um, corporate property is legally separated from the property of shareholders. So if a company goes bankrupt, it is not like the company is not gonna like go to your house and take everything because you invest in them. Okay, so the corporate is separated from the shareholder. They cannot, the only link between them two is the share itself. So, for example, if you own 33% of the share of a company, it is incorrect to say that you own 1/3 of that company. You will instead own 100% of 1/3 of a company's share. Okay. Remember, shareholders do not own the building, the factory, nor the employees. This is owned by the corporation itself and not the shareholder. Your cash will basically help the corporation to buy all these things or all these assets. Okay, so how to make money from stocks, right? Like nowadays, after the crash on March, um, people seems to be rushing into the stock market, and but really, guys, how to make money from stocks? Okay, so there's two basic concepts here. If you're a bull, okay, it basically means that you want the stock or the underlying company. You want to buy their shares at a low price and sell it at a higher price. All right. That is the concept when you're a bull. Okay. So you're bullish on the stock market. You guys may heard this. It means that you think the stock will go up. Okay. If you're a bear, you will sell at a high price and buy back your shares at a lower price. Okay. This is mainly gonna be institutional traders or banks. They are mostly bears. Okay. All right. So a quick example. So we have Tesla share. Okay. So by the 16th of February, a Tesla share cost $796. Okay. Um, let's say you want to buy 100 share. So your cost will be one the amount of shares times the price of the stock. That gives you your cost. Okay. And then if you want to buy and be a bull, your action will actually be a buy to open order. Okay. So it means that you're opening a position by buying a share. Okay. That could be also known by BTO. And okay, so let's say Tesla is trading lower, so it's not a good example. Okay, but let's say Tesla is trading at 900, at 900 price, right? So let's say by today it's at 900. So my long position was initially 100 shares, right? So the the um the the calculation to determine your P&L, which is your profit or loss, it's going to be the number of shares times the actual price, the current price of the stock, minus the cost. Okay, so with this example, my P&L will be 100 times 900 minus 79 79k. Okay, so my P&L will be let's calculate quickly. My P&L will be up, I will be up $10,400. Okay, if Tesla is at 900 and if I bought them at 796. Okay, so that is the way to calculate your P&L for a stock. But let's say that we're a bear. Okay, like we're some big banks, and we want to short Tesla. So I pulled the Tesla chart here, and we can see that Tesla now is trading at 781. All right, the 781 level. So right now Tesla will be at 781. Same stuff. Same stuff, right? Oh no, I actually have the wrong chart. Okay, sorry guys, I actually have the wrong chart, so need to get this going in. Okay, All right. So we were talking about bears, right? Bears want the price to go down. Okay. So when they do that, the action that they're gonna be doing is called short selling. Okay. You guys may have heard that already. But what is a short sell? A short sell is the investor borrows a security and sells it on the open market, planning to buy it back later for less money. Okay. Um, Important to note that because you borrow your share, you actually need to pay short interest for the broker, right? You will have a short interest that the broker will charge you because when you short sell a stock, you basically loan the amount of share that you want to short, you loan it. So it's loan money, so there will be a short interest on your position, and it require a margin account. Okay, you cannot short a stock while having a cash account. I think so. Okay, but I'm pretty sure that you need a margin to short sell. I've never short sell, to be honest. I've never short sell a stock. Okay, but it might be a strategy that I might implement in the future. So example of a short. So same example, Tesla was at 796, 100 share, but now your action will be different than if you were a bull, right? Your action is now to sell to open. So STO. Um it's gonna so the previous one was buy to open, but if you're a shorter, your action will be actually a sell to open. Okay? So let's say Tesla is trading at 700 right now. Okay? Your short position was 100, and then now you want to buy back your position, right? So your buyback position will be 100 again, and your P&L will be calculated as this. So the price shorted minus the current price times the amount of shares. Okay, pretty easy. 796 minus 700 times amount of shares 100. It gives you that you're in profit of $9,600. Okay, and if you want to close your position, your action will require a buy to close (BTC). So pretty much the opposite of sell to open. It's gonna be a buy to close. All right, you can trade. You can actually trade a lot of equities in the stock market, right? It's not just shares. Shares is the most basic and common form of equity that people trade. Okay, it's gonna be shares. Um, yeah, so shares represent the equity ownership of a company. Simply that. You have no time decay. You, you don't need to take into account the time factor. You don't need to take into account other stuff that other equity has that are required to understand. But let's go straight to options, okay? A lot of people are trading options here in Wiseguy. Most of our trader trade options, okay? So an option is a contract to buy or to sell an underlying asset at an agreed upon price and date. This can also be called the strike price, okay? And the company does not profit from the transaction. So this is purely investor between investor, just exchanging contract, okay? Exchanging contract that said that a price will reach that amount by an X amount of time, right? Um, okay. So after that, we have warrants, okay? It's a little bit different, but warrants is the same thing as option, but the shares that are issued by the company. Okay, so you will be exchanging with the company itself. Okay, so for example, if you buy a a warrant, the shares that will be in your warrant will be created by the company itself. Okay, and the company does profit from the transaction because they actually issue your share. Okay, there's also futures. um, they're the same as option, but the holder is obligated to take possession of the underlying commodity at the expiration date and at the expiration date only. Okay, options you can close your position on any time after that you bought, after that you open the position. You can cancel it like anytime. You can sell your options anytime. But futures, you actually need to wait until the expiration date to close your position. Okay, and you guys need to remember that these equities, they are traded in different exchange. Okay, so for example, the futures are traded in the CBOE exchange and not the New York Stock Exchange, for example. All right, so here I am at my second subject. So if you guys have question on stocks, like right now, it's the time. No question? All right, good, good, good. You guys are good enough. All right, Nima, question. I ask you to unmute yourself, Nima.
Yep. So we said that the bears, you said that the bears are generally banks and big institutions, right?
Yes.
And there is so much talk about, following the big money. Then why are not like more of us retail investors following, those
Banks?
guys?
Very nice question, right? Very nice question. And you know what? I think the reason that caused that is that people, like normal people, like traders like us, we don't like to be negative on a stock. We don't have that kind of psychology going into the stock market because we as human, we want everything to go up, right? But I think the only reason that not a lot of people are doing that is because it's a psychological reason, right? People wants to go in the stock market to be a bull, not a bear. Okay, like bears are only people that have a lot of money. They usually have a lot of money, and they use that money to to short the stock that they judge too overvalued. Okay, and yeah, all right. Um, okay. Aaron, can you unmute your question? Yeah. Yeah,
Yo,
Aaron.
can you hear me?
Yes,
Hey,
yes.
it's not a question. It's just for the notes. If you guys are wanting the notes, don't add me. Just send me a message with your email, and I'll quickly add you to the Google Doc. I won't give you editing privileges just because like I have OCD, so I like my notes clean. So I'll just write the notes and share it with all of you.
All right, thank you, Aaron. You're goated.
Yeah, I'll just plug the Discord tag again. It's AARON #0409. Just send me a message with your email, and I'll add you to it. AARON #0409.
Yes, sir.
Yeah.
All right.
Let's get it.
Thank you, Aaron. Ler, can you unmute yourself?
Why do we look at futures in the morning before trading?
Because futures actually drive the actual stock market. Okay, futures trader, they kind of priced in like the futures before the stock market. Does that kind of make sense? Like futures, they you guys know that the S&P 500 has a future exchange. Okay, it's called the ES, and the Nasdaq also have a future exchange. It's called the NQ. Okay, and these future exchanges, they basically drive the market, and they give a direction to the market before the actual market. So that is why we oftenly look at the futures before, before we trade, because futures are gonna tell us if the day is green or red or whatever. And you guys can do technical analysis on future as well. Like they perfectly use technical analysis. Okay. Jay Jr.
Hello.
Yes, yes, yes.
I had a question on shorting stocks. So you're saying that it's not for like retail investors, it's more like for like bigger companies, bigger players, basically that have a lot of money, right?
I'm just saying a fact. Like, not a lot of retail investors are gonna be shorting stock, and that is because, like, psychologically, people are not comfortable shorting something,
So if
like in
you
the stock
understand the
market.
whole aspect of the psychology and you understand that it's a given that it's gonna go down, would it be smart to try it out as a beginner?
100%. Like why would you be a bull when you know that the stock is gonna fall down? Like be
Yeah.
a bear, you know?
Okay, cool. Just okay. Thank you.
All right, Bucks.
Can you hear me?
Yes, sir.
All right. So on option trading, I guess I'm pretty new to this. So you buy a contract at a
Yes.
certain amount, and then you have to sell it a certain amount agreed upon. Is that correct?
You don't need to sell at that specific price. For options, you buy it as soon as you buy the contract. The next second, you have the right to sell it.
Okay, but it can't go over the amount agreed upon, correct?
No, it can go an X amount. It doesn't matter.
Okay, thank you.
You're welcome. Okay, guys. 5 minutes is over. I'm sorry for all your questions. Reserve it for the end of the class. All right. Oops. All right. So let's go through some brokerages. Okay. Brokerages are the platform where you actually can buy or can sell a stock. Okay. Brokerages are gonna be the platform where exactly you will buy, sell a stock on a broker platform. Okay, so here is some brokers that you can use. Okay, if you're in the US, you have TD Ameritrade or Thinkorswim. I think a lot of Wiseguy member uses TD. Okay, there's also Webull that is very very interesting. A lot of people are also using Webull. But if I have Canadian in the room, okay, Interactive Broker is the broker that I'm using right now. Okay, I love this broker, to be honest. Great platform. Canadians also have Questrade. Okay, very very interesting choice. You guys, Canadians may know Wealthsimple. Okay, Wealthsimple sucks, guys. Like, get the hell off that broker. Okay, it's not good for you guys. My European friends, you guys have trading 212. I'm not sure if it offers like every equity, but I know that trading 212 is a European broker. Okay, so if if you guys are European and you guys are telling me that trading 212 sucks, then don't use it. Then you guys can also have Coinbase, but this one is for Bitcoin. Okay, for crypto. So you guys can buy, can sell Bitcoin with Coinbase. I think there's all the crypto in Coinbase, so everything that you can think of. So Coinbase is a crypto broker. And guys, our Discord is very there's a lot of content in there. Okay, so if you scroll a little bit through the Discord, you will find a place where we place brokers and free stocks there. I can pull it really quickly here to show you guys. Give me a sec. Where is it? Okay, so it's right here. You can basically go a bunch of broker, and you guys can see their up and down, or if you guys like them or not. So go into the introduction section and then brokers and free stock. Okay, big chapter right now. Brokers usually offer two types of account. Okay, cash or margin. A cash account. Cash account require that all transactions must be made with available cash or existing long position. When you buy a security in a cash account, the investor must deposit enough cash to settle the trade. Okay. Just a quick reminder: cash account in the U.S. takes 2 days for the cash to settle. So don't forget that rule. If you plan to invest on something soon with a cash account, don't forget that you need 2 days for your cash to settle. Okay. And unlike a margin account, cash account do not allow short selling or trading on margin. All right. So I was saying I was not really sure about that earlier, but I have the confirmation now. Cash account do not allow short selling. Margin account, using use the current cash or securities in your account as collateral for a loan. Okay, this is a little bit more tricky here. I know a lot of people do not want to have a margin account. They're scared of. Okay, margin investing can be advantageous in case where the investor anticipate earning a higher rate of return on the investment than he's paying on interest on the loan. So this is pretty easy to understand. If you're planning to make a higher percentage than compared to the interest that you will be paid for your margin will be advantageous in these case. And to be honest, the interest rate that you paid for a margin account, it's usually low. Okay, so your trade will usually go more than, well, just as a general rule, your trade usually goes more than 2 or 3%. Okay, like I don't think that you guys just plays 2 and 3% plays. Leverage given by margin will amplify both gains and losses. Okay, this can be scary, right? In the event of a loss, a margin call may require your broker to liquidate your security without your consent. Okay, this is a little bit scary. Recently, we saw that Robinhood kind of did that, and I think it's very scary that you guys have a, well, it's not scary, it's just that they actually have the right to sell your position without your own consent. Okay, guys, so just be careful of a margin account. Me personally, I've always used margin account. Okay, um, I've I never had a problem with it. And usually when you don't have enough funds, your broker will tell you that you cannot go into a position because you don't have enough settled cash. So your margin will not be like to the roof, and that, well, with that, you're restraining yourself from like big losses. So okay, I like this slide a lot. Okay, is to understand the main difference between cash versus margin account. So a margin account lets you borrow from your broker. A cash account doesn't. With a margin account, you don't need to pay the full cost of the investment upfront, as your broker covers part of that for you. And if you have a cash account, you can only make investment that you pay for upfront using the money you have in your account. So let's jump in an example. Okay. Let's say that you open a margin account. Okay. You open one, you're interested in for having a margin account, you want to up your game. Okay. And your broker let you borrow up to 50% of your investment. So that is huge, right? That is enormous. Okay. Imagine that you have 5K in cash in your margin account and you want to buy Apple shares at $100. Okay. So if you have a cash account, you will have the buying power to buy only 50 shares, right? So 50 times 100 is 5K. So you can only buy 50 shares. But let's say you open a margin account, right? So you will have the buying power now to buy 100 share. So like 50% more. Okay. But you will actually owe the bank 5K with interest now, because you invested your first 5K, but your broker let you borrow up to 50%. Okay, so that means, oh yeah, I think I made a little mistake here, guys. Some math that I didn't handle very well here, but it's supposed to be 7.5K basically. So you can buy around like 75 shares instead of 100. Okay, but the concept is the same. Okay, the concept is the same. when you have your broker that can leverage your account, you can basically have a bigger buying power. So here are some margin rates for some broker that you guys may know: TD, Fidelity, Schwab, Robinhood, IBKR. Yeah, so just before choosing a broker, please see their margin rate. Okay, please, and compare it to their peer so you guys can have a nice deal. Okay. All right, PDT rules. Okay, this is a special rule, very weird rule, to be honest, for you guys. It stands for pattern day trader. Okay, the PDT rule places certain restriction trading. This designation was put in place to discourage investor from trading excessively. So this rule was made by the SEC, Security and Exchange Commodities. They actually want to protect you guys, to protect retail investor for not to not like overload their account, and they pretty much restrain your trading if you are tagged as a pattern day trader. So the consequences of this PDT rule will be that your margin will be reduced, okay? Or your broker might block you from buying or selling a stock. So that is kind of scary, right? You get into a position and the stock goes in a way that you didn't plan to, and you want to get out, and now you can't just because of that PDT rule. So just be very careful, okay? And once your account has been coded as a PDT, the broker will continue to regard you as a PDT, even if you do not trade after that for a 5-day period. Okay, like we're gonna jump into the PDT rule more in depth, but just it's important to know that if you're already tagged as a PDT, you will continue, like the broker will continue to stand that tag on your account. Okay, who are targeted by this rule? Okay, so all US margin accounts that are under 25K are subjected to this PDT rule. Okay, so I can assume that most of you guys have a cash account or margin like under 25. No, by the way, the PDT rule it only applies for margin account, right? So no cash account, only margin account under 25K. Okay, so what is considered a pattern day trader? Like the first time I heard about this rule, I was like, what is that? Like, why does American have that rule? And the rule is basically this: it's executing 4 or more day trade within 5 business day. Okay, so if you do that, you will be tagged as a PDT. And then we can ask ourselves, what is a day trade? Okay, a day trade is purchasing and selling, or selling and purchasing the same security on the same day in a margin account. Okay, so for example, if you're buying Apple at open and you sold Apple at 3:59 Eastern before market close, you will be tagged as as a day trade. Okay, but for example, if you're buying Apple shares on open, like for example Monday, and then Tuesday you sell it, it is not considered as a day trade. Okay, very important to understand. And what if your account drops below 25K? Okay, you will actually need to add more fund to your account, and you need to always maintain that account at the end of the day. Okay, so each end of day, in order for you to not be restricted to this rule, you guys need to have more than 25K. Okay, to be honest, I'm a Canadian, so I don't have this rule in Canada. But if you do have if you guys have more question about that, I highly suggest you guys to ask one of our support, which lives in the US and know the rule better than me. because to be honest, I don't really know a lot about this rule. Okay. So yeah. Do we have question about like cash or margin? I have a lot of question, but I don't know if they're all for the for this section, guys. Oh, and by the way, guys, if like if your question was already like answered, please just get your hand down so I can know that you don't have a question. All right, Nicola, I ask you to unmute yourself. Yes, Nicola? Christian? No, I can't hear you, bro. Okay, sorry. Nick? No. Nicola Zaiden?
Hello.
Yes, yes.
So I have two questions. The first one was I'm currently using Trading 212
Okay.
to trade, and what I wanted to ask you is in there you can have a cash account or a CFD account. Is
Wow.
CFD considered margin account or is it something different?
Ooh, I'm very sorry, but I can't really answer you that question. I think you really need to contact your broker or somehow just find the answer, because that is a very important question, by the way. Like you want to know, you want to understand like all the terms of your broker, but I cannot answer that question for you because I've never used Trading 212 and I don't know a lot of people using that. So, yeah. Sorry. Damn. A lot of question. Nimai.
So I found out first what the CFD account is, contract for differences. I think it lets you trade futures. And one other question was about warrants. I apologize if it's not this cash account, but
Yes.
about the warrants, can you exercise warrants? Like how do warrants work?
Oh, to be honest, warrant can be exercised, I think, before the expiration. I think you can do that.
Mm-hmm.
They're basically the same as options. Okay, they're basically the same concept. So you have an expiration date, you have a strike price that you need to go by there, by that time, and but the main difference is that, like, for example, if it's an option, it's
Mm-hmm.
like trader between trader, right? But warrants are trader between the company itself.
Company. Okay, perfect. Perfect.
Okay,
Thank you so much.
you're welcome. Asif Ghaffari.
Hi, how you going?
Hey.
I've got a question. I live in Australia. I
Oh.
don't know what platform to use to options trade. What are some platforms to use here down under?
Okay, let me try Australian broker. Is there a thing? Okay, so I have the best online brokers for Australia. I think you can. Oh, there is interactive brokers for Australia. Okay. Asaf, I know that well, me, I'm using IBKR Interactive Broker myself, and I love that platform. Okay, and I'm seeing right now that you can actually have that platform in Australia. So you may be looking to that, but I have other names that is popping, 5 names. So maybe you can research on Google, and I pretty much just type in like brokers for Australia, and it gave me like five names,
Thank you.
including Interactive Broker that I know very well of. Christian Nicola again. Are you able to unmute yourself now?
Yeah, can you hear me now?
Yes, now I can hear you.
Yeah, sorry, I was having mic troubles before.
Okay.
Yeah, I know some people put this in the chat already, but just for anyone who wasn't looking at the chat and didn't notice, earlier, Fong, I think you said that Coinbase allows you to trade all cryptos. And
Yeah.
I just want to say this for anyone out there, because I made this mistake. I actually made a Coinbase account to trade like Dogecoin when it was at its hype, and I found out that Coinbase only allows you to trade a certain amount of cryptos. But there's a way for you to search
Mm,
it. If you Google it and you Google what cryptos Coinbase allows you to trade, it'll tell you a whole list of them.
okay. Very interesting. I do not trade cryptos. So I mean, I don't have any clue on how crypto works a lot. So, but I like I have a Coinbase account, you know, but I never really use it. So, but man, Christian, thank you for the info. Nick Krushke.
Yes, yes. Can you hear me?
Yes, sir.
All right. So you said that it takes 2 days for funds to settle in a cash account.
Yes.
That's just for stock, like trading actual stock. Options only take 1 day.
Okay. Oh, okay.
Just
Interesting.
so that everyone knows.
Yeah. Guys, like I may sound like stupid because I don't know a lot of the question, but the main reason is because I don't have like I don't know the US rule a lot, you know. And I'm sorry for that, to be honest. But like the information is very easy to find on the website, and your broker 100% on your broker's page, you will have info for everything. Okay. So just be aware of that. Oliver Wood.
Yeah, are there any PDT rules for Canada?
No, they're not. They're not. We don't have PDT rule. God, yes. Yeah, I can't believe how I'm gonna trade if we have PDT rule in Canada. But thanks, Oliver, and thanks, Nick. Nicola Zaiden. Last question, maybe.
Yes. So I wanted to ask you, what kind of information do you think it's important to research, or what words do you think are specifically are the ones that we should look out when getting into a brokerage account or searching for a brokerage?
What kind of word?
No, because for example, when you see these brokers on Google, you can see that they have low fees and everything.
Yeah.
But then when you start digging in more, you can see that they have some kind of like deposits or withdrawal limits and how much you can trade and all that.
To be okay, to be honest, I've never had any problem with any of my brokers. When I subscribe to any new broker, okay, and I've subscribed to 3 news, okay, they always says to you the original amount that you need to deposit. They tell you all the requirement, but they don't tell you about their margin rate, their interest rate, their numbers, like the technical stuff. So maybe if you want to look more into that, and I think it's a great idea, you can look for most of broker has like a chat service where you can chat with people. I think that could be a great way to find like more info. But apart from that, I guess that Google will be your best friend, and you can search for words like interest. So for example, like if you're on Thinkorswim, just type like Thinkorswim interest rate for margin account, right? For example, I think you can pretty much do that. Yo guys, I have a lot of questions and I want to answer you all, but I really need to continue. Okay, I don't want to drag this for too long. It's already nearly 9. I wish that you guys have a lot of food and water by you. Okay, so let's go into a more fun, a funnier, well, not funnier, but just less stressful subject. All right, so indexes, market indexes. Okay, very, very interesting subject. Okay, so market indexes, what are they? They're a portfolio of investment that represent a segment of the financial market. So another word, an index is a group of company that are like united through one index, or like we can like it's not a stock because you cannot buy, for example, the S&P itself, but you can buy like like uh, derivative, like deviations of S&P, whatever. I'm gonna get into that after, but it's actually like a group of company that is united through an index, and that index is pretty much, it can be used as a your like a health indicator of the overall market. Okay, so the value of these indexes comes from the price of the underlying holdings. As I said, for example, the S&P 500 stands for Standard and Poor's. It is basically calculated by the price of each holding of the S&P 500, and it gives you the value of it. Okay, very important here, very very important. Indexes are weighted by like factors. Okay, I know that the S&P is weighted by market cap, but other indexes can be weighted as by revenue, share float, or fundamentals. Okay. Justin, why are you doing this? All right. So yeah. So for example, for a oops. So just an example for a weighting method. Okay. So the S&P. Let's dive in straight into the S&P 500. So let's say a company. Okay. So for sure, a company with a 10%. Oh my god. I thought that I canceled all the annotation. It's weird. Okay. All right, sorry guys. So a company with a 10% weighting would have a greater impact on the value of the indexes for sure compared to a 2% weighting, right? So the higher the percentage allocation to companies will be given to largest market cap in the example of the S&P. Okay, so S&P uses a market cap weighting method. Okay, so let's take an example with Apple. Okay, so Apple have this amount of shares, around 17 billion, at its end of its 2020 fiscal year, and it had a stock price of 128. Okay, as of December 21. So if we calculate the market cap, it's gonna be the stock price times the common shares. So we're at $2.2 trillion, and the market cap of the S&P is at 31.6 trillion. So basically, you just do you divide Apple market cap by S&P market cap, and it gives you a Apple weight of 7%. So Apple is weighted 7% of the S&P 500, basically. Okay. So here are some list of indexes, the major indexes that are like that people trade. S&P 500, which is in the US. Okay, so it's it's 500 large cap companies. The S&P 500 is one of the most viewed index to represent the health of the US stock market. Some big companies are in there, like Tesla, Apple, Softy. Okay, so most of the large cap companies will be in the S&P. An indexes can also kick out a company for making place for other company to go in. So for example, for the case of Tesla, you guys may know that recently Tesla had an inclusion into the S&P 500. So actually the index, the manager of the index, need to kick out some companies out for making space for Tesla example to come in, right? So the indexes work like that. Nasdaq is also a major index. It is it is a lot more tech oriented compared to the S&P, and it has over 3,100 companies. The Dow Jones, one of the most famous indexes, is only 30 industrial companies in it. Okay, the Dow Jones and the S&P, well, Nasdaq, Dow Jones, and S&P are the three most viewed like market index by investor, because they represent very well the U.S. stock market. And in the Dow Jones, you have Disney, Salesforce, Walmart, and 27 other companies. They're mostly industrial. Okay, so in the industrial sector, you guys will also have the Russell 2000. Okay, Russell 2000 is the index of the small cap stocks. So in this index, you guys will have basically 2,000 companies, right? You guys will have 2,000 companies that are considered a small cap, and Russell 2000 is for the U.S. also, and it's basically the S&P, but for the small caps. Okay, so it's the Russell 2000. A lot of you guys are trading in this index, and I noted that a lot of you guys do not know like this index, and I think it's a little bit scary for me, because most of retail trader trade small caps, but they don't even look at the Russell 2000. Okay, it's very important. Okay, S&P 500 VIX is known as the S&P 500 index for its volatility. Okay, you guys may heard this name. When the VIX goes up, the stock market goes down. Okay, so the VIX is also used as a hedge against the stock market. Okay, like if you like in the next session, I'm sure that this will be discussed. Okay, hedge. What is a hedge? And here's a list of other indexes. You guys have the Canadian, Brazilian, Germany, France, British, Euro. So yeah, pretty much all country have well, not all country, but like more like the Occidental country will have usually a stock exchange. So I want to show you guys some example, okay, of how indexes work, kinda, and oops, sorry. And yeah, so here's an example of the weekly chart of Microsoft. So if you guys have your trading view, you guys can pull it over so we can look at it together. So this is the weekly chart of Softy since 2017 to 2021, and this is the S&P, same time frame weekly since 2017 and 2021. So I just want to point out that those two chart looks a lot the same, right? So we can see the big March drop. Microsoft did a big March drop here. Another drop around November 2018, I think. And we can see S&P 2018 had a big correction. Also here on March 2018. Okay, so March 2018, November, March dip, same thing on the S&P. So what is the what's the point? The point is stocks that are in the S&P will look a lot like the S&P. Okay, so Softy, Tesla, Apple, Zoom, like all these names, they will follow their indexes, and basically they will have the same chart. Basically, like if S&P is going for a massive correction, expect that a company in the S&P will go through a massive correction. Okay, and it's logical because the S&P is the accumulation of all its holding, and it's given the value of it. Okay. So here I pull 3 index on the same 1 hour time frame. I have the S&P, Russell 2000, and the Nasdaq. So I want to point out to you guys that even indexes, they move along together. Okay, you guys can. So 1 hour S&P, 1 hour Nasdaq, you guys can see that this chart looks a lot the same. It has these like literally the same details in it. You guys can see this kind of 4 day no, not 4 day, like 4 hours like run up. You can see the same run up on the S&P, and then this big flush down on the Nasdaq. The Russell, for its part, it's a little bit like it's running more on itself, but you guys can still see the similarities between them too. Okay, so you guys can see market correction around here. Russell, same thing, market correction. Some choppy side action right here, choppy side action on the 1 hour of Nasdaq. So my point is just that the indexes, they move along together too. So yeah, usage of indexes. Okay. Indexes represent the overall market performance. Okay, indexes are used as a benchmark to gauge the movement and performance of market segment. So we know, for example, that S&P is the 500 like large cap company. Nasdaq is more tech oriented. So for example, if a day that tech is running, well, you can expect the Nasdaq to run, right? But not necessarily the S&P. Okay, and for example, if the Nasdaq run, you will have the insight that tech stock are running pretty much. So everything related to tech, cloud, everything, Softy, Apple, Amazon, like all this, like all these names, they will likely be flying. Okay. Investor can also use indexes as a basis for their portfolio or passive index investing. The reason for this is that indexes are like, they're considered very safe. Okay. People tend to say that if you have a higher return than the market, you know that you have a good trading strategy or investment strategy. Okay. And that is and the reason of that is because indexes are used as a gauge or like as a benchmark for the whole market basically. So they're like one of the in quote safe investment side. Me personally, I don't invest in indexes. Okay, I don't, because I think because it's not my strategy. My strategy does not need me to um, to have to invest in indexes. Okay, it can serve as a safe and diversified investment if you need a safer choice. Maybe an index will be appropriate for you. So okay, guys, some like I saw some people in the voice chat, for example, I was calling spies going down, and then some person asked me what company is that. Okay, and I think that is very scary to me, because like you guys need to understand these basic things, right? So for example, so the indexes, they have fund that you can invest in directly. So as I said earlier, you cannot, for example, invest directly into the S&P 500 or the Nasdaq or the Russell, but you can invest in ETF that is composed by the same company. Okay, and for example, the SPY will be like SPY will have the same movement as the S&P, because it is the ETF of the S&P. Okay, triple Q, the Qs, or QQQ for Nasdaq, same thing. If you want to invest in the Nasdaq, you will be investing in the QQQ. Okay, and Russell 2000 will be called the IWM. This is the ETF of the small cap, and all these names, there are ETF that is part of the family. Okay, they call that the family of funds. Okay, so TQQQ will be, for example, it's the same thing as the triple Q, but it is more leverage, for example. Like, okay, and for example, if for the SQQQ, it is the opposite of the QQQ. So basically, if you think that the Nasdaq will actually fall off, you will buy SQQQ calls, or you will buy SQQQ stocks, right? If you think that the Nasdaq will crash in the next, I don't know what, Okay, so you guys can use these fund as a hedge against the market. Okay, a very popular technique among experienced trader. When the market does not go well, you play hedges. Okay. So here quickly I want to go through some chart. This is the S&P 500 chart since 1995. We can see these. We can see that back then S&P this is the monthly chart. Okay, so each candle is 1 month, is the represent 1 month of trading, and you guys can see the difference back then, right? Like when we were at these 1200 level, we don't have a lot of price action, and it's very stable, right? So um a run up, slowly run up through 4 years, and then correction, and then further movement, and then big correction during the tech bubble. Same thing, right? Very stable and steady, and then it flushes down. The 2008 financial crisis, and then we have been on a bull run since the 2008 financial market. And if you guys see or remark, you guys can see that these our recent candle, they're a lot more volatile than the than than the past, right? Like that you guys can see this big candle that that represents 200 point, 300 point, 500 points, and then here back in 1995 you can it's barely 40 points. Okay, so we're in a very volatile market, guys. Just by comparing the length of the candle in the monthly, you guys can understand that we're in a very volatile market right now. Big price action going in both ways, to the downside, to the upside. So yeah, just want to point that out. And here's the Nasdaq. You guys can see that the chart looks a lot the same. Okay, as I said, this is the monthly from 1996. And Dow Jones, same thing, guys, same thing. Okay, very volatile right here on our level right now compared to the past. All right, questions. And guys, I have seen some people drawing into my presentation. Just a message to you guys: if you have more time, if you have free time, and go do something else. Don't be in this stream and disturbing other people. Seriously, just get out, just do something else. I'm not I'm not angry at you, but just be respectful, you know. All right, Shane Ward has a question.
Following, I have a question. It's more on the last segment,
It's fine.
pattern day
It's fine.
trader, but what about good faith violations? Can you talk a little bit about those? Is there a difference between that and margin calls or cash accounts?
Good faith. Good faith. What? Sorry.
Good. I
Good
think they're called
faith restriction.
good faith violations or restrictions. If cash accounts, if you sell a trade and they're not, the cash is not settled within a couple days, and you're making trades before they're settled.
Okay. Okay.
I don't believe you have that settling issue on margin accounts, but you do on cash accounts.
Okay, yeah, I'm reading it right now on Webull. What is a good faith violation? I'm gonna pull this in this. What a GFV occurs when you liquidate stocks that were bought on instead of proceeds. Oh, okay. Basically, when you sell a stock and you didn't wait for the cash to settle into your account, and then you take that cash and you get into a new position, I think that will be that is a good faith violation.
I mean, if you buy a stock, it's immediate once it's traded, and once you sell a stock, isn't it immediate once it's traded? Why does it need to settle?
No, it's not immediate. Okay, you need to understand something. In the U.S., the system goes like this. Okay, when you buy or sell a stock, your order goes into a. It's called house something. I'm not sure of my terminology, but it goes into like a house where that house will actually do the transfer of equity like between traders, right? And that house required 2 days to settle your money. And the purpose of that house is to assure investor that they will get their money, like yeah. So they will just like the purpose of that house is to guarantee that the buyer will send money and the seller will like send their money. Like so it's just a regulation like it's just a house that needs to settle the trade between like investor. So that is the reason why you guys need 2 days to settle. Okay. Miguel, question.
Oh, yeah, it's Miguel. But I
I'm
wanted to
I'm
ask,
sorry.
okay, why is the market so volatile right now?
Cause very nice question. Cause we are in a time where retail trader has never been that active in the stock market. Okay, since the March crash, we saw retail investor increase like a lot. Okay, so that is the reason why we are seeing some very high volatility right now, and also because of the overall like situation in the U.S. Okay, the economy, the crash of the economy, the COVID, all the 2020 was the election year, and all these external factors um, does have an impact on like investor in the stock market. So there's a lot of different variables that like can answer your question, but I think the main phenomenon that we can see right now is retail investor flushing in the stock market and pretty much pumping money that the government like give to you guys, helicopter money basically. So because of that, price get inflated, and we're pretty much in a very volatile market. All right. Abubakar Sultan, question. Abubakar, do you have a question?
Hi, can you hear me?
Yes, sir.
Yeah, I actually wanted to explain for a brother asked for warrants. So
For warrants.
if you want, I can
Yes.
I can explain the
Yes. Go
warrants.
ahead.
So actually, to everyone, I'm gonna start from the beginner. My name is Abu. So I've been trading with Wiseguys about a couple of months now. So warrants are actually when there are two ways of company to do IPOs. One they do through traditional way, which is doing a normal IPO. The one is through a SPAC. When they create a SPAC, there are two ways to raise money for the companies. One, obviously, they sell the shares in the beginning and they raise the money. And the second thing, warrants. That's an extra way to raise money for the company at the later stage. So whenever they need. So when they release the warrants first time, they're valid for 5 years. So once you buy the warrants, they're valid for 5 years. That's their expiry date. Along with the expiry date of the warrants, there is another condition. The company, you can only exercise your warrants once when the SPAC merger is finished with another company. And there is another condition in that. Though the expiry is 5 years, you can keep them until 5 years, but the company can call the warrants anytime and you have to exercise. And if you don't exercise at that time, you lose your money. For example, if the warrants are the stock trading at $10 and the warrants will be probably trading at $1, $1.50. To change your warrants when you exercise them, mostly companies charge you $11.50 dollars to change your warrants into a stock. So when you exercise your warrants, you pay company additional money. That's how they raise money, through warrants at the later stage after the merger, to change the warrant into stock. For example, I own some CCIV warrants, and I bought the warrants at the price of $5. So at the moment, the stock is trading at maybe $60. Warrants are trading at $35. If I want to cash my gain, I can just sell the warrants right now. But if I want to wait for the merger, and if the merger happen, and once the merger happen, I can activate my warrants and exercise them. All I need to do, just pay the company $10.50. That's in their contract. Every contract is different between $10.50 to $11.50 dollars, and they will change my warrants, and they will give me shares instead of my warrants. If I have 100 warrants, I'll get 100 shares. The most and dangerous downside of warrants, are you guys listening?
Yes. Go ahead.
Yeah, the most and downside of the warrants, let's say if the SPAC normally have 3 or 2 years, I think so, to finish their merger. If they don't finish their merger, they have to refund the money to the investors. So the people who has invested in the SPAC itself, they probably get $10, but warrants get discarded. You don't get any money back. So you can make money through warrants 2 ways. Either because warrants has a low float than the shares. So obviously, if a share price goes up by 10%, for example, most likely on the day warrant will be about 15-16% up. So if you want to cash out, like my warrants, I owned at $5 100 warrants. At the moment, CCIV warrants, because it's a hot stock, that's what I'm talking about it. It's warrants about $35-$34. If I want to cash out, I can cash out now. But if I want to wait, once the merger is done, I can just pay $10.50 additional money per share, and I can they will change my warrants into share. That's the simple psychology of warrants. The validity of warrants are 5 years, but the company can call off the merger anytime whenever they raise the money. And if you don't exercise them, they just discard your warrants and you lose your investment.
Wow. Okay, but like, do you have a certain amount of time before like exercising your warrant? Like, is there an expiration date?
Once you buy your warrants, you have 5 years to exercise them.
Okay, like all warrants. It doesn't matter.
It doesn't matter,
Wow,
because warrants are mainly on the SPACs. So it's the way to raise additional money for the company at the later stage. But obviously, when company call in warrants, or when you change, when you exercise your warrants, the current stock value devalues, because those shares comes in the market. They're not in original float of the company.
Exactly.
They're actually separate float, which allocated to the warrants, but you can convert them into your shares by paying additional money of $10.50 per share, something like that.
Yeah. So exactly as I said, the shares are issued by the company, right? So when you exercise your warrant, it's pretty much you said that we need to pay, and then the company will give us like the shares.
They will, they will change the warrants into shares. But warrants are normally cheap. Like I don't know if you know this, another SPAC which is going on. It's on crypto, like LION, Line, right? The warrants are at the moment trading at 60 cents. So if people buy the warrant at that time, because crypto is going up, so stock goes up. So you don't really have to wait for the merger. There are ways to make money from the warrants. Like when the stock goes up, when I give you example, I've just sold those warrants. There is another SPAC founded by Richard Branson, which is called VGAC. They just finalized their merger a couple of weeks ago, 3 weeks ago maybe, with a company called 23andMe. So their stock priced, I got that warrant at $2. Their stock price was trading at about $14. It went up by 20%, but the warrant on the day was up 80 or 70%. You can sell your warrant at that time. As well. You don't have to hold the warrants. It's like an investor of shares, but the only downside, if the company can't finalize the merger and they return the money back to investors, who owns the share, normally it's $10, they will just dissolve the warrants. You will not get any money back. That's the only downside of warrants.
Okay, very interesting.
On the other side, like you mentioned with the options, the premium you have paid, if you don't exercise the option, you lose the premium. Similarly with the warrants, if you don't exercise the warrants, you lose the money you paid for the warrants. It's kind of an initial premium which will change those warrants into share by paying additional money. But in options, obviously, you don't pay additional money; you just exercise the option. That's the difference.
Yes. Thank you a lot. That was a lot of wow, a lot of information.
I was
Yeah.
listening to. I just joined the chat actually a half an hour ago because
Okay.
I'm in UK.
Okay.
It's 2:20 in the morning.
Yes. Yeah. Yeah, I understand. And thank you for your explanation for warrant. I do not. I didn't trade warrant like ever.
Well,
So yeah.
many platforms don't allow warrants, but
Yeah.
luckily,
Exactly.
many people use interactive brokers. They do allow warrants.
Okay.
I use interactive brokers. I use Trading
Yes.
212, and to be honest, in US it's very difficult. Like you buy and then you have to wait. In UK,
Yes.
probably in Canada, it's very easy. You buy, you sell it. You don't need to wait for a settle account, settle funds. You can buy again. You can sell again. There is no cash limits. If you have a cash account, there is no limit. There is no day trade limits. It's quite cool in UK, but I think so.
Okay.
In US, it's very very different in terms of taxation and other things as well.
Yes. Okay. Thank you, Abu, a lot. Thank you.
No worries. Thank you very much.
All right. So guys, I want to jump in the last section. Okay. The time passed quick, right? Okay. So this section is very, very, very interesting. Okay. I want you guys like this is an assignment for you guys. Okay. It's like I'm gonna talk about what kind of trader are you? Like how are you planning to making money out of this stock market, right? So let's think about it. I think that the main difference between most investors are are their mentality, right? Are they more focused on long term or short term investing? Okay, that is a question that you need to answer yourself. No one will answer that for you. Okay, so long term investing. I'm gonna start by that. I put some image of like special of like many famous investor long-term investing. Okay, so Peter Lynch, a very 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 famous value investing guy. This guy has been on Wall Street since like before well, for a long time. Okay, I read some of his work. Very very resourceful. Warren Buffett, no one else than this famous Warren. Um, he's pretty much the god, well, the first god of value investing, right? And then we have Kathy Wood, that wonderful woman who has been killing her return on the stock market, right? I think her ETF, the ARK ETF, was voted like the best ETF of 2019 and 2020. Okay, highest return of all the ETF is owned by this woman, Kathy Wood. And then we have Chamath. Chamath, this very very resourceful guy. His project is basically to bring on SPAC. Okay, his company is willing to bring on um, like SPACs from IPO A to IPO Z. Okay, so around 26 SPAC. His plan is to become the next Warren Buffett, basically. this wonderful Chamath. Okay, so let's start by some fun fact again. Most of hedge funds manager are not achieving a better return than the S&P 500. Okay, most of hedge fund managers are not achieving a better return than the S&P. That is very interesting. Okay, you guys wants to find the next CIV, the next GME, the next AMC, but the people who actually manage million and billions of dollars, they do not achieve a better return than the S&P, which is around what 4-6% a year. Okay, so just have that in mind, guys. That it doesn't mean that you have big money that you will have a big return. All right. The three biggest mentality of long-term investing is growth, value, and dividend investing. Okay, this is a quote that I put it. Long-term investing is much stable and safer. Having a long-term account is always something that I praise. I think that a 60 and 40% ratio is well balanced for both growth and stability for your portfolio. This is my personal opinion. I'm not saying that I follow this rule, but I think having a ratio where your long-term investing will have a bigger part, a bigger weight than your short-term investing is a very balanced way for both growth and stability. Okay, so let's start by value investing. What is that, right? What is value? What is Warren Buffett doing in his spare time? Okay, value investing is the style that invest in stocks that are trading at a lower valuation. Okay, so let's take an example. You have the same TV. Okay, whatever the model, I don't care. You have the same TV. You have it at full price and one that sells 50% off. It's the same TV, same quality picture, same aftermarkets, same everything. Okay, it's literally the same TV. So a high quality company can see their price fall off for X reason, putting them in a low at a low valuation price. But the quality of this company often remain the same. Okay, it is often caused by high volatility in the market or some news. Okay, a perfect example of that is, for example, EH. Okay, if you guys know this name, I'm gonna pull the chart of EH. This this EH had a very drastic drop. Okay, that this big drop that was caused by a short report. Okay, so that is a common thing that can happen in the stock market, where stocks just get shorted by bad news or by some banks that don't want the name to be trading that high, or for whatever reason. Okay, stuff like that can happen, guys. This is very dangerous. Okay, so if you're a value investor, you will find this company where are trading at um, a lower price because of X reason, oftenly like bogus. Okay, so you will invest in this company because they're trading lower and the company like just remain the same basically. So a value investor will pick stocks that appear to be trading for less than their book value. Very interesting here. Okay, what is a book value? A book value is the total assets of the company minus intangible assets and liabilities. Intangible assets are assets that are not material. Okay, so basically, like the ownership of like a new technology. So it's not like something like uh, material, but like when you charge for um, for an idea, for example, you need to pay fees to acquire that idea, right? And basically, those are called intangible assets. So book value is pretty much all the assets of a company without its liabilities and intangible assets. So the pure, like, what is the company worth right now, right? Just just the asset, just all the infrastructure, the cash, the stocks, whatever. So it's the company value. It's called the kind of the book value. Um, so if it's trading less than its book value, you can consider it as a value pick. Okay, so the concept is very simple. If you know the true value of something, you can save a lot of money when you buy it on sale, right? It's pretty simple. But a lot of people in the stock market are doing the complete opposite. They're buying at a high price and they sell it on a lower price. Okay, so it's just weird, you know. Mentality. A good mentality to find these stocks is you need to think like the stock market is underestimating the company. Okay, and I know a lot of company that that Wall Street does not put into your news feed because of, I don't know, X reason. Okay, for example, what is one of the hottest sector right now? I think the AI sector, right? You guys can agree with me that the AI sector is very, very interesting. Yet, this company, Sirens, okay, they have they have shitty options. Their options are horrible. Okay, they don't have any volume on their option. But look at their stock price. it has been in a slow and fast and steady run since 2020 when they were trading at $20 and now they're at 129. Okay, this company does AI, the AI system for the cars maker. Okay, so they basically work with Tesla, Audi, a German's car, Italian car, Ford, GM. They're working with all of them, and Wall Street is not. Wall Street don't talk about this stock. Serents never. They never talk about them. Okay, and this has been like on my eye since this summer, since the 50 area. So you guys can find these kind of stock where people are just not talking about, and you can invest in them because they have great business model, great 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 financials, great fundamentals. Okay, so think it like the stock market is underestimating the company. How do you recognize companies with a low valuation, right? And by the way, guys, valuation mean the value that investor gives to that stock. Okay, and this is purely based on demand and offers. Okay, so for example, Tesla right now, everyone can say that Tesla has a high valuation, right? But the company itself is 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 like enormous. It's a different kind of business model. It cannot be simply evaluated by some parameters like P ratio, EPS, some basic like valuation method like that. It like sometimes stocks cannot be evaluated with simple with basic valuation method. Okay, but the simplest way to spot a low valuation stock is to look at its fundamentals or some ratio to determine how healthy is the company. Okay, so you will have some metrics that you can note. I highly suggest you to note this. P ratio, forward PE. P ratio means price to earnings ratio. It is a fundamentals that um, that pretty much tell in itself if the price action is too high compared to its earning or too low compared to its earning. So P ratio, forward PE, earnings per share, price to book ratio, PEG, gross margin, and many more. Okay, and the mentality you want to have when searching for value investing stocks, that you need to search for companies that are trading at a lower valuation than its peer. Okay, so for example, um, let's let's talk about, for example, EV, right? So no, maybe not EV, like let's say for example tech. Okay, there's a lot of tech company. So tech company will kind of have their range of valuation that they're in the same like kind of range. Okay, tech usually are very overvalued, but they still stay in these region because investors want them to be at at these price level. But normally tech stock, they have a very high valuation. Okay, that means that they're overvalued most of the time, but it doesn't necessarily mean that the stock will go down. You just need to understand that the price is overvalued compared to its fundamentals. But the stock market is like sometimes fundamentals doesn't count into their trading plan, and stocks can be trading at a very high valuation, like Tesla. Okay, Tesla is trading at a valuation of around I think 1,000 P ratio. Okay, which is gigantic. Nobody, I think Apple has like a 40 or 60 P ratio, and Tesla has 1,000 P ratio. Okay, growth investing, very interesting this one. Okay, growth investor typically invest in growth stock. Simple as that, right? What is a growth stock though? A growth stock is any share in a company that is anticipating to grow at a rate above the average growth of the market. So, in other words, stocks that um, are usually small caps, usually just started, usually are a SPAC or some company with a new product, new business model that goes into the stock market. Those are called growth stock. Okay. The mentality to have for picking growth stock. Emerging companies can provide impressive return if the companies are successful. Okay. However, such companies are untried and thus often pose a very high risk. This is the SPAC model, guys. When you heard about SPAC, CCIV, people are rushing into CCIV, right? This is emerging. They're calling this the new Tesla, right? Emerging companies that provide like impressive return. It's exactly true. CCIV does offer a lot of growth, okay? But it's high risk. Why? Because they didn't like even deliver a car yet. So you guys that are betting in CCIV, you're pretty much betting on a company that doesn't have any revenue yet, right? So with that mentality of being in growth stock, you guys to need to be aware that usually growth stock are not that solid of a company compared to value investing. So a growth stock is a company that comes from emerging sectors, okay, usually driven by technology advancement. And growth stock are mostly traded by retail traders. So me, you, the 600 people that are in this Zoom, you guys are retail trader with me, okay? We're all retail. We are all interested in these kind of stocks, growth investing, okay? So some example of growth stock, okay? Plug, SBE, SNPR. So these three, they're in the battery and charging technology. So with the electric vehicle coming, these names are popping because of that. Okay, and then you have online gambling. Okay, DraftKings, Pan, Skills, all these names. This is a new business model to the world, right? That we can bet money on, like on a computer, like it's totally like recent, right? And then you have the cloud servicing. Okay, you have Snow, Amazon, CRM, Cloudflare. So all of these names, they are providing a cloud service solution for companies. Okay, cloud is the new way to work. Cloud is the new way to work. Again, I'm in the engineering like industry, and for our data, it's only cloud. Okay, cloud is becoming the standard of the world. Okay, so look out for these company guys. Let's get into dividend investing right now. Okay. Okay, so dividend investing, some of you guys may know it. It's a little bit boring as a strategy, but it's the most efficient way to get money out of the market. Okay, dividend investing is the most stable way to get your money out of the stock market. Okay, they pay companies pay dividend in the form of periodic cash payment, and they're paying you cash just for holding their shares. Basically, they can pay their cash quarterly, monthly, or annually, or on a semi-annual basis. Okay, so some stocks can give you dividend monthly, more some monthly, quarterly, annually, but usually it's quarterly. Usually it's each 3 months you will have a dividend. Okay. Why dividend investing? Right, shows that the company is strong financially and have a stable cash flow. Okay, like imagine this, guys. Imagine a company. Will a company like CCIV give you guys dividend? No, right? Because the company is not even strong financially. Okay, a strong financially strong company, like for example AT&T. Well, AT&T is not a great example here. Don't take it. But let's say for what is a nice dividend stock, like um like I think some energy stocks have very nice, like the Exxon Mobil, the CVX, like all these names, they offer great um great dividend, right? I think 5% around that, and you are benefiting from the compounding effect. Okay, and I can't put enough emphasis on compounding. People don't realize how compounding is strong. Okay, so let's take an example. Let's do an example. Okay, just a quick mentality check. Dividend investing is the most consistent stream of income you can get out of the market. So let's go by opening up this tab. This is a compound interest calculator, basically. What is a compounding effect? So I'm gonna show you like right now. So let's say find out how your investment will grow over time with compound interest. Okay. So let's say I'm a small guy account. Okay, I have a small account. It just started. Blah blah blah. I don't have money. I don't work. So let's say I put in 2K. Okay. 2K addition. How much money can I add? Let's say, okay, let's try 0 actually. I don't have money. I'm poor. I don't have money. And I choose an interest, like my portfolio has a rate of, let's say, 8% each year. Okay, each year I have 8%. And I expect to retire in 45 years. Okay, by 65 I retire. So with that being said, your initial investment of $2,000 with an 8% rate each year because of your dividend, in 45 years, your account will be at 63,000. Okay, so you guys can see here how powerful compounding is. The reason why people are not realizing this is because most of traders nowadays are chasing the next GME, are chasing the next CCIV, are chasing the next whatever, I don't care. They're chasing the next home run, basically. But by fact and history, compounding has been the king since years, since the debut of investing. Compounding is the core, is the basic of investing. Okay, so just with 2K that I never put more money, I'm like at my retirement I have 63K. Okay, it's enormous. Let's say now that monthly I'm making a shitload of cash, so I can put in, let's say, something like logical $200 per month. Okay, with the same interest. So let's calculate. $1 million. By 65, you guys will have $1 million, and your total interest is 900K. Okay, if these numbers are not like blowing your mind up, I don't know what will blow your mind. Okay, these numbers are incredible. If you put in $2,000 as a debut and add in $200 monthly, you're getting into $1 million by 65. So what's your excuse, guys? I don't know. What's your excuse? I don't really know, to be honest. But yeah, the power of compounding. I can't preach that enough. Okay. So here's a list of some stocks that pay dividend, that pay this nice dividend. So this is the Dow Jones list. So we have Boeing on the top at 6%. Okay, and when you look at dividend stocks, you need to look at also their dividend growth. Like, are they growing their dividend each year, or is the dividend stable? If they grow their dividend, it's a sign that the company is solid financially. Okay, so you can get some very nice company that has a high return, like Zom, ExxonMobil, 7.8%. You have Boeing at 6%, IBM 5.5%, and these are strong companies, right? BA, IBM, ExxonMobil. I know I actually don't think it's ExxonMobil, but like it's an energy. Like I know that Zom is like energy sector, but yeah. So you guys can get pretty decent like amount of dividend, right? Usually to have a nice dividend stock portfolio, this is not a golden rule again, but I would say that around 300 to 500K, you can start to have a nice dividend portfolio. Okay, when you have around 300 to 500K, then you can start dividend investing with like you will actually make some money out of it, right? Because let's say if you have 300K and you have a 8%, it will give you 24,000 cash per year, cash free. That government, I think government cannot tax your dividend. Okay, so you basically have 24K sitting in front of a computer, or if you're in Hawaii, that you're in the beach and you still receive 24K. Okay, so that is how dividend investing works. My personal strategy. Okay, interesting. This is personal, guys. I'm not your financial advisor. So yeah, I combine value investing with growth investing. This is my method since the beginning. Okay. With that being said, it's pretty easy. For example, I found Neo at 11. I was in Neo at 11. Skills at 18. Servants at 50. All right. I was in these names because they were growth stock, and they were company that has nice fundamentals that matches the value investing part. All right, so I combine both worlds to make my strategy. This is how I make money. Okay, and you guys can clearly see that it works, right? Neo at 11, skills at 18, strengths at 50. Okay, these are all running right now. Okay, so this is how I find my long-term picks. Okay, it's by combining those two. So here are some guidelines that I have, that myself, my own rule that I need to respect. Okay, before investing in a long-term position in a company, I try to truly understand their business model. Okay, and I try to think if they have enough resources to survive against its competition. So, for example, let's return to Neo. Okay, Neo understand their business model. Neo is basically an EV, right? They're selling EV. So when Neo was out, I did my DD, due diligence on them. I go through their numbers. I love them. They're backed by the Chinese government. It's good. Fundamentals check. Okay. Second check. Are they in a growth investing? EV, yes sir. Okay, we're going in. Is Neo can Neo survive against its competition? Yes sir. Neo is backed by the government, right? So it's basically mean that the Chinese government will never let Neo die. Okay. When the company offers a viable product or services, okay, what does Neo offer? EV, the future. They were offering the future basically to the world. All right. So it's a and Neo had the technology for it. They had the infrastructure to build them. So I consider it a viable product because it's not only the final product like the car. You need to have people, you need to have engineer, you need to have all the people working behind the curtains to really make a viable product, compared to other names that don't have even a product in their EV like catalog, right? Strong management team is a key point, especially for SPAC. Okay, SPAC. Strong financials and free cash flow is king. Okay, this is the last parameter that I'm always looking for a company. If they're strong financially, do they have a strong, stable free cash flow? Free cash flow is basically the amount the amount of cash that is going through a company in a yearly basis. Okay, and here I just put it a quote that I preach. Starting with value investing is essential from my point of view. And the reason for that is just because when you understand that something is undervalued, just by like, for example, the best example, Neo was at 53 not long ago. And then in my head I was like, okay, NEO is purely like undervalued right now, because NEO was trading at 60 like the last month ago. Like a month ago NEO was trading at 60 and now it's trading at 53. So just by knowing this factor, I went in and bought NEO without doing any technical analysis, without doing any research. I just bought NEO because I knew that I was getting a discount just because of market correction, right? Like NEO didn't have a short report, NEO didn't have X blah 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 news. So I saw that NEO was undervalued, boom, I got in, you know. So yeah. Short-term investing, I think this is the main force of Wiseguy, right? Short-term investing. So first strategy will be scalping or day trading. Okay, the concept is simple. Trading style that profits from minor price change in a stock's price. Okay, so small change of maybe 0.5 to 5%, and then you go and play a relatively big amount of share to do a leverage for the small price movement. Okay, so you want to catch small price movement during an intraday chart, and you want to profit from these movement by putting a big amount of shares. I know that usually traders, for example, like if it's a low price stock, people can go in for 500 shares, like for one, like just for opening one position, it's 500 share, and then they scale up, they add in 10,000 shares. So scalper usually go with big amount of stocks. Okay, scalping is relatively the easiest style of trading for me. Okay, thus a big majority of traders will fail. Why? Because it required an impressive capital size in order for you to respect a logical risk management. Okay, so you guys maybe may know a bit about this risk management. Vibe's gonna talk more about it tomorrow morning. Okay, it's gonna be a very interesting course, but that is the reason why, because most of trader will fail is because they don't have a big enough portfolio. So here's an example of a scalp that I did with NEO. I think this is the 8th February exactly. So here's an example. I'm gonna explain it pretty vaguely. I'm not gonna go in depth in indicator or anything, but basically I entered NEO right on this support. I betted on the rebound of this support that was given me by the previous day low. Okay, so the previous day it has 56.17 and then around 56 as a low. So I knew that 56 was a like a consolidation. Well, not a consolidation, but it's a zone where NEO cannot go below. Okay, and then as soon as it touches that level, I wanted it to rebound. So I basically bet that the stock was going to rebound on its support line. Okay, so first position here, and then it went up. By here I'm at 70%. I'm at 70 cents up. Okay, this is a nice point to get out if you want to trim profit. But for example, I actually added a bigger position here, because it's going to take off the opening day. Okay, this is a little bit risky as an entry, because normally you will wait you will actually wait for for the price action to cross, for example, this level, and then enter into a position. But me, I played like riskier. I accept the risk, so I entered here when it popped after this open, and then I rode all the way up. Okay, first resistance here at 58, I trim profit. Okay, because it's my resistance that is given me by the day before, the high of the day before. So I trimmed first trim, second trim, fourth trim, last trim, way up here. Okay, so I basically caught a whole $3 movement of NEO in an hour. The trade lasted an hour. Okay, so yeah, pretty decent return. If you do on options, it's even greater. Okay. Swing trading right now. Okay, most of you guys are swinging. Widely the most popular style among traders. Okay, the concept is very easy. Style of trading that attempts to capture short to medium term gains in a stock over a few period of days to several weeks. Okay, so this swing, guys, it requires patience. Patience with a with a with a Y like after the A, right? Patience, as the legend used to preach, right? You guys need to be patient when you're swinging. It's not a 1 or 2 day thing. It's a weekly thing. Can be a monthly thing too. The goal of swing trading is to capture a chunk of a potential move. Okay, so this is basically the mentality that you want to have. It also have the time factor. Okay, if you're trading an option, when you're swinging, you will have the time factor that goes against you. Okay, so it means no, yes, but by here trading. Okay, so pretty much when you're swinging, you want to involve multiple different length uh of holding a stock. Oh, okay. So it basically means that here, you like a swinger can hold a position for days, weeks, or months. Okay. It's not like day trading or scalping, which is in 1 day only. Okay. So some settings that you need to be aware when you're swinging. Okay. Your risk reward ratio. So your potential risk versus your potential gain. Technical analysis, multi-framing analysis. Okay, very important. Overall market condition. Is the S&P is it pooping right now? Is it in a bad condition? So are you guys gonna long Apple if the S&P is looking like it's gonna crash? You know, news, earnings. Okay, so news that the company gives, it can impact your position, earnings. Okay, unusual volume, smart money, in other word, and many more settings to be aware. And here's a quote that I just put. Swing for me is the most complex style of trading. Okay, most of the time beginners are not aware of the overall market signal. Okay, they're oftenly tunnel vision on their position. Okay, I find this quote very interesting. Here's an example of a swing setup. Okay, you guys know small cup and handle pattern. So this huge cup and then the small retracement, small pullback. Okay, and basically if we trade this pattern, it's called the cup and handle. Entry will be above the handle, so right around this level. No, actually this candle, this last red candle, so 192.70, your entry will be there. Your stop loss will be below the handle, so this line here, this level here, 187.50, below the handle basically. And your price target will be at 204, 205, so around these level. So you then have a risk reward of $5.2 to 11.30. So you're risking $5 to achieve $11. So that is great, right? Great risk return. The logic behind risk reward ratio is you want to have a positive. So it's around 2. This is inversely done. So I basically divided the 11 by 5. That is why it's giving me 2. But it's just the way that people write it, right? So maybe this may be reward / risk instead. And then by looking at this swing setup, you guys can see that we entered here. We did this huge run on Apple. 205, 204 get filled very quickly. And then if we held, the stock could have gone to 228. And this trade would have lasted 2 months. 2 months, guys. This is a 2-month trade. Okay? So it's not always like days or seconds or minutes or hour. Like people are swinging for months. Okay. All right. Small assignment for you guys. Are you guys ready? Are you guys ready? Okay, this is not gonna be. Don't get scared. It's nothing. It's nothing to be scared of. Okay. So the assignment is this simple assignment. Choose the best investment style that fits you the most. Okay. Hey, I just want to add something maybe. The most depending on your life settings. Okay. I think this very, very interesting. All right. So the scope of this assignment is this. Determine what kind of investment strategy suits you the most based on your current life settings. Determine how much risk are you willing to play. Determine what kind of technical setups you want to play. And determine your overall investment strategy. This is important, guys. This is your future. This is your plan to retirement, right? If you guys are younger than 20, like this is the mentality, the mindset that you want to have when entering the stock market, right? So I want you guys to determine what kind of style fits you the most, right? So here's some question to help you answer that question. Am I working a 9 to 5? Okay, this impacts a lot because, for example, if you're working a 9 to 5, you will not be scalping because when you do your 9 to 5, the market is happening. The market is starting at 9:30 a.m. Eastern and it's closing at 4. So you basically don't have the time to scalp. Okay. Do I have a family? That is very, very important. Okay, guys. If you have a family, for example, you cannot risk like me. Like me, for example, I'm willing to let my position go to $0. I don't care. Okay. But if I have a family, it may be different for me. I may be not investing with that mindset. Okay. How much time are you ready to put into the stock market studies? Okay. For example, most of full-time traders, do you guys know how much time traders are spending in front of a screen reading? Okay. And I'm telling you this like right now. Okay. A lot of you guys wants to be a real trader. Okay, right? Like full-time trader, I want to do this for my life, blah blah blah. Okay. If you don't want to read, if you don't like to read, go do something else. Like trading is not for you. Okay? Pro traders are putting more than 15 hours in front of the screen per day to read. Read articles, to understand companies, how they work, business model, who are they working with, who are they merging with, other financials, reading the 10K, 8K, filling of the IPO SEC. All of these require your time, right? So right now, guys, I'm telling you, if you don't like to read, go do something else. Seriously, go do something else. Because stock trading is all about reading stuff. Okay, you need to read a lot. You need to do a lot of research. Okay, so for example,
Slide over there. Slide over there.
Huh?
To your car.
Nice. Just gonna mute you all again. Sec. Okay. All right. So let's get back to this. How much percentage of my money am I willing to put in the market? For example, I have 100K. Okay, I'm worth 100K. How much percentage of my money I'm willing to put into the stock market? Am I willing to put 30%, 30K, 50K, 100%? You know? So ask yourself that question. Like it will help you find the right investment strategy. So for example, if I can put like 20%, I'm not gonna I can be okay. So I would say that the smallest percentage that you put of your net worth into a trading account, the smallest, you will have small return and small loss. Okay, so just think about it. The higher percentage you put, you'll get higher gains but higher losses. Okay, so that is the logic. What is your end goal? My end goal, guys, Fong Caviar Play only goal is to retire at 40. That is my goal. Okay. Am I saying that I'm gonna achieve that with stock trading? Not at all. Okay. I have plenty of other methods to do that. Trading is only a tool for me to get into that goal. Okay. What is your risk tolerance? 10, 20, 30%? How about 90%? So, for example, if Brad, so Brad, I'm just taking an example on you. So, for example, Brad has X condition, I don't know what. He doesn't want his money to go below 30% on a position. Me, I'm willing to risk 100% of it. So it's two different risk tolerance, right? It's two different account. It's two different two different type of managing an account. Okay, it's totally different. What metrics are you comfortable using when evaluating a company? Are you a number guy? Are you a technical guy? Or are you a guy that just follow news? Right? Okay. What kind of return are you expecting short and long term? Am I expecting 10% each month? Am I expecting 10% each year? Am I expecting 50% a day? You know, it's all gonna impact your trading strategy. So think about it. Try to come with more questions. Okay, the more question you ask yourself, the better. These are just questions that I can think of when I was doing the slide, but I'm sure that you have plenty of other questions that are applicable to your setting, guys. So there's no right or wrong answers. This is for you. This is for your personal use. Okay, these questions, remember, guys, no right or wrong question. This is for your own mental mindset entering into the stock market. Okay, this exercise may guide you for the rest of your financial adventure. And the most important, don't lie to yourself. You'll be the only one suffering. I will not be suffering if your strategy tells you to do value investing and you go scalping. It's not my fault, it's your fault. Everything you do in the stock market is your fault and your fault only. Okay? Please understand that. Okay, guys. A meeting on Thursday night. So I'm gonna write a note down. Thursday night, the 25th Feb. Okay, I'm gonna review some. If you have question about your assignment, if you have answer that you want to discuss with me, if you answer the question that I asked, but you kind of don't know what kind of trading style to use or investment style to use, I'm gonna be there for you. Okay, so on Thursday night, the 25th February, I haven't decided the time yet, but you guys can be assured that it's gonna be recorded, it's gonna be posted on mentor session and everything. And guys, remember this. The Nehemiah, I'm just gonna have I'm just gonna finish the presentation. It's done soon. Okay. Remember, guys, we are investors. Okay. The end goal of investing is to have a higher number on the end line. That's it. That's your job. That's the job of a trader. Your number at the end of the day needs to be higher than yesterday. Okay? If you can't achieve that, you have a problem. Go find your problem. Go do some troubleshooting. Okay? And remember, nobody has the same account. Take your personal approach. Investing is a solo profession. You're responsible for the decision you make. And I love this last quote, guys. The market is a place to grow your wealth, not for creating it. What does this mean? Can someone tell me what does this mean? It's a very weird question, right? Nima, can you answer me that question?
I could have take a shot at it. I mean, you know, you can grow your wealth. You can't just create money out of anywhere, right? You need like that discipline, you need a plan, you need your head in the game, and you need a little money to play with. And only then I guess you can uh, create more wealth.
Okay, so here's the point of this quote. The market is a place to grow your wealth. If I have 1 million and Nima, you have 1K, we do the same trade. Which one are gonna be less stressful? Which one are gonna be less worried about its position? Which one is going to have less stress, less emotion going into the trade? Nima, can you tell me?
All things kept equal, I think the guy with $1 million is going to be stressing more.
Why?
But then,
Why?
because there's the 1 million on the line. If he makes a wrong turn, like 10% for him is lot more than 10% for me, who's $1,000.
Yes.
Right? For me, I lose what, $100, and for the million guy, he loses million. I don't know how much he loses.
So
100 grand.
So 100K. 100K.
Yeah.
Like 10% is 100K, right? So by this quote, the guy with $100 million, he doesn't need 10% to be happy. He doesn't need 10% gain to be happy. He needs 1%. He needs 2%, and his week can be done. Okay, guys? You guys often ask, how much money does a day trader needs to have? Blah, 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 right? The reality is a lot of money, because exactly because of that example and of that quote. If a guy with $1 million lost 10%, it's 100K. If a guy that lost so if an account have 1K and he lost 10%, it's $100. It's not the same game, right? The guy with the 1K portfolio, he will search for home runners like CCIV and GME. But the guy with $1 million, he's gonna be more smart with his money. He's gonna invest it. He's gonna find ways to find those small percentages, 1, 2, 3, 4, 5% that he's happy with. Like I know it. I know personally. Okay, I know a crypto trader, my age, that has more than 400K in his port. Okay, the guy told me this. His rule is simple. Whenever he reached 4% of his account in 1 week, he's done. He don't trade anymore. He doesn't need to trade. All right. So that example show you this. The market is a place to grow your wealth because you already have wealth. Right? If you don't have wealth, don't throw it into a investment strategy that has 3% win rate. 3%, guys. This is some serious statistic, right? 97% of traders will lose money or will quit after the first year, and 50% of the remaining will quit the next year. So you're left with 3%. 3% of traders make it. All right, I'm gonna let you with that stat. Okay, last quote: success with money, family, relationships, health, and career is the ability to reach a personal objective in the shortest amount of time, right? With the least effort and with the fewest mistake. The goal you set for yourself and the strategy you choose become your blueprint or plan. I preach a lot about trading plan, remember. Strategies are like recipes. Choose the right ingredients, mix them in the correct proportion, and you'll always produce the same predictable result. In this case, financial success. Brought to us by Charles J.